Ever wonder why everyone keeps telling you that you need 20% down to buy rental property? Spoiler alert, they're probably just repeating what their uncle's neighbor's financial advisor said at a barbecue back in 2008. The truth is way more interesting and a whole lot messier than the conventional wisdom floating around your social media feed. So imagine you're sitting there with maybe $3,000 in your checking account, scrolling through rental listings and watching everyone else build wealth while you're stuck believing you need a small fortune just to get started. You've probably heard the gatekeeper say you need 5% down minimum for rentals, maybe 10, maybe 20, depending on who's lecturing you that day. But here's the kicker. The rules aren't quite as rigid as the real estate industrial complex wants you to believe. Let's pull back the curtain on what's really happening in the lending world. Traditional lenders love their safety nets, which is why they typically want 15 to 25% down for investment properties. It's their insurance policy against you bailing when things get tough. But here's what they don't advertise in those glossy mortgage brochures. There are more loopholes in this system than a tax code written by lobbyists. Picture yourself as a first-time homebuyer looking at a duplex or a triplex. Suddenly, the game changes entirely. You could potentially move into one unit and rent out the others with as little as 3.5% down through an FHA loan. The bank doesn't care that you're secretly building a rental empire, as long as you're living there too. Now, you're probably thinking, but wait, doesn't that defeat the purpose if I have to live there? Here's where it gets delicious. You only need to occupy the property for 1 year, then you're free to move out, keep it as a rental, and repeat the process with another owner-occupied property. It's like a real estate cheat code hiding in plain sight within the federal lending guidelines. The VA loan game is even more generous if you've served in the military. 0% down on a multi-unit property, as long as you're occupying one of the units. That's right, $0 down to start building passive income. Meanwhile, civilians are being told they need to save for a decade before they can even think about investing in real estate. But let's say you don't want to live with your tenants, because sharing walls with strangers who blast music at 2 a.m. isn't your idea of wealth building. There's still the USDA loan option if you're willing to invest in rural areas, 0 down, government-backed, and yes, it works for multi-unit properties in eligible areas. The catch is, you've got to be in designated rural zones, which sometimes includes suburbs closer to cities than you'd think. Here comes the plot twist that nobody talks about at real estate seminars. Some local and state housing finance agencies offer down payment assistance programs specifically designed to help people buy multi-unit properties. We're talking grants and forgivable loans that can cover your entire down payment. The programs exist in almost every state, buried under bureaucratic websites that look like they were designed in 1999. Now imagine you've got a decent relationship with a local community bank or credit union. These smaller lenders aren't bound by the same rigid rules as the big national banks. They can create portfolio loans with terms they decide themselves, sometimes going as low as 5 or even 0% down if they believe in you and the deal. It's relationship banking from a bygone era, still alive in pockets across the country. Seller financing is where things get really creative. You find a motivated seller who owns their property free and clear, and you negotiate to pay them directly instead of going through a bank. Suddenly, down payment becomes whatever you can negotiate, which could be 5%, 2%, or even nothing if the seller is desperate enough or the deal is structured cleverly enough. Let's talk about the house hacking strategy that's turned thousands of regular people into accidental real estate moguls. You buy a small multi-unit property with a low down payment owner-occupied loan, rent out the other units, and watch their rent payments cover most or all of your mortgage. You're living for free or nearly free while building equity and learning the landlord game without risking a fortune. The hard money lending world operates on completely different principles than traditional mortgages. These lenders care about the deal, not your down payment. If you can find a property significantly below market value, a hard money lender might finance up to 100% of the purchase price. Of course, you'll pay higher interest rates, but it gets you in the game when traditional financing won't. Here's the uncomfortable truth that real estate gurus don't emphasize enough. Lower down payments mean higher monthly payments and potentially private mortgage insurance eating into your cash flow. The math has to work, or you're just buying yourself a part-time job that costs money instead of makes it. Running the numbers isn't glamorous, but it's the difference between investing and gambling. So, you're probably wondering why everyone doesn't know about these options if they're so available. The answer is marketing, my friend. Big banks make more money on conventional loans with big down payments. Real estate agents aren't trained to educate you on creative financing. The system benefits from you believing you need more money than you actually do. Imagine the housing market as a game where most players don't know half the rules. While everyone's saving for that elusive 20% down payment, a small group of informed investors is using these alternative strategies to build portfolios worth millions. The knowledge gap is the real barrier to entry, not the money itself. Let's address the elephant in the room about risk. Lower down payment means less equity cushion if the market drops. You could find yourself underwater on a rental property faster than you can say 2008 financial crisis. But risk is also the price of admission to wealth building. And calculated risk with proper research beats sitting on the sidelines every single time. The qualification process for these low down payment options isn't exactly a walk in the park. Lenders will scrutinize your credit score, debt to income ratio, employment history, and the property itself with the intensity of a tax auditor at a casino. You'll need documentation for everything, including probably some stuff you didn't know existed. But knowing what's required means you can prepare instead of being surprised. Here's where the strategy gets layered. You could start with a low down payment, owner-occupied loan, build equity over a few years, then refinance and pull cash out to buy your next property. Each property becomes a stepping stone to the next one. It's like playing real estate monopoly, except the money is real and the properties don't fit in a box. Some investors are combining multiple strategies, using a low down payment loan for the purchase, then immediately finding a tenant to cover costs while they live somewhere else and claim it's their primary residence. Is this legal? In most cases, yes, as long as you genuinely intend to occupy the property. Is it ethical? That's between you and your conscience, but the rules allow it. The reality is that 5% down or less is absolutely possible for rental property investment if you know where to look and how to structure the deal. The gatekeepers want you to believe it's impossible because complexity maintains their position as necessary intermediaries. But the information age has democratized knowledge, and now you've got access to strategies that were insider secrets 20 years ago. Let's bring this home with some real talk. The best time to start investing in real estate was 10 years ago. The second best time is right now, with whatever capital you can reasonably deploy. Waiting until you have the perfect amount saved means watching opportunities pass by while prices climb and rental rates increase without you participating in the gains. Think about where you want to be in 5 years. Do you want to still be reading articles about real estate investing, or do you want to be the one with actual properties generating actual income? The knowledge is available, the financing options exist, and the only thing standing between you and your first rental property is decision and action. So here's your homework assignment. If you're ready to stop dreaming and start doing, head over to www.growthsense.com where you'll find a comprehensive directory of investment properties across the country. Whether you've got 3% down or 20% down, the right deal is out there waiting for someone smart enough to grab it. The question is whether that someone is going to be you or the next investor who stumbles across the same opportunity. The game is happening with or without you, so you might as well get in while the getting's good.